have you heard about this?
Well, let's start talking about it
Before
yet.
I'm just going to ask you, the Zweig breath thrust indicator?
Oh, yeah, I've been seeing that in social media, and Pretzel, I think, mentioned it or something like that. So I haven't dug into it or what it's about.
Yeah, I just found the first article and I was like, oh boy.
Well, welcome everybody to the Half Truth, where we talk about the latest headlines or headlines that caught our attention, and we focus on what's truthful and what's potentially not so truthful, or the underlying meaning that they're not really grasping. So today's Half Truth with us is, I am sober.
That's super convincing. So one of us is buzzed. Well, I'll let you kick it off then, since you kicked it off so well in the beginning.
Well, sadly, I don't have a Jim Cramer. I don't know.
He's been kind of quiet lately, huh?
He has been kind of quiet. So, and the stuff he has kind of reported, hate to admit, he's been right as of late. Now, will it hold true? Who knows? But so I can't bash on him this week. But the first one that I have is that the UPS is reducing their pilot headcount by nearly 200 with buyouts. And my second article kind of goes along with this. But so in essence, what UPS is doing is they're cutting their pilot group. And what that's really not talking about, or the article doesn't really fixate on, is the fact that UPS is cutting back. FedEx is cutting back. So that shows that people aren't buying as much shit. We're not shipping as much stuff. Not as much stuff is coming in, going out, type of thing, because they don't. This is the first time in a long time that pilot group has cut. So that kind of is a leading indicator of our economy is not doing so great.
Yeah, I know. I saw an article or a tweet or something about how they had to, the more recent jobs report, they've now finally figured out what the actual numbers are versus what they posted or gave us.
Yeah, it was mostly
and it was
government
much higher.
Well, it was government jobs leading that, yeah.
Right. Well, that's crazy. So you said how many were getting laid off?
200.
Wow. What's their now this is for them flying was this UPS you said?
UPS. So they're trying to pretty much buy out the senior pilots. One, it'll help them, reduce costs because they won't have to pay the pension, or, they don't have to pay their salary, because those 20, 30-year captains make quite a pretty penny flying for UPS. So, I mean, some of them make $34,000 a month, and they barely fly. They fly half the month. So it would save them a lot of money.
Sounds like we're in the wrong industry, other than them getting not laid off, but I guess probably, what do they give them, a severance package?
Right.
Yeah.
And like I said, my second article kind of goes in line with that. So we can save that if you want, or if you want to dive into it. So the second article is, American Airlines dangles a $250,000 bonus to poach FedEx and UPS pilots. So they're not really poaching active pilots, pilots that are there. What they're trying to do is attract the pilots who are getting bought out of their pension to come to American Airlines. But it's not really American Airlines. It's a subsidiary of, so they kind of skew that headline. They're not going to be jumping to American. They're going to be jumping to an airline called PSA, which is a subsidiary wholly owned by American Airlines, because the regionals are hurting so bad for pilots. So a $250,000 signing bonus for these, 50, almost 60-year-old captains to come fly, to be a captain flying a CRJ 200, 700, 900 type of thing.
Wow. That's a nice bonus. Jeez.
It is, but it goes to show you, like, my first year when I was an airline pilot, my first year at a regional like PSA, I barely made $20,000. And now most, regional airline pilots going into the industry are making anywhere between $80,000 to $100,000. So it shows the change and the shift in dynamic that has happened in that industry and how much more they're getting compensated for being there.
Wow. Well, the nice thing is they don't have to retire. That can go right into there. So how does that work? They get a signing bonus. Maybe we can give, so you get the 250. Is that in stock? Is that in just a check they write? So you got to pay capital gains on that, or?
I don't know the full structure, but typically it'll be, you'll get, some of it might be right up front and you just have to make it through training. Some of it will be, day one, you show up to class and you get it. Some of it might be over, a period over the first year, you get it in stages, type of thing. So it just kind of depends on how they structure it.
I bet it's got to be in stages. There's no way they would just cut you a check for, oh yeah, hey, you applied, you got the job, here you go.
Yeah.
Because I would bounce. I'd be like, all right, how can I go get another easy 250?
Right.
Well, that's crazy. So, I mean, do you think that's going to affect? Well, we got the holidays coming up, Black Friday's coming up. Speaking on that, Amazon got rid of their return policy or return places at Kohl's, and now it's all done through UPS. So, kind of interesting. You got the holidays coming up. UPS is downsizing, and you're going into the hottest part of the season when it comes to shipping. So,
Yeah.
and that whole Amazon thing is nuts too, because I know it's a good deal I'm sure it's a good deal for UPS. An article, I guess, to maybe find in the future, but a good deal for UPS. But man, for my wife who buys and returns things all the time on Amazon, going and returning something at Kohl's was far better than UPS. Their customer service is terrible.
Really? We got a UPS right next to us, so I would just walk in, they'd scan my label and, take the package. It was very rare that we would return something at Kohl's.
Oh, yeah. See, we always did ours at Kohl's, and perhaps I'm being a little biased because it's really the UPS store that's right here next to where I live. And the few people that work in there seem to be very easily agitated, and they're
It's
not
only
very
going to get
happy
worse
about.
as we approach the holiday season too.
Well, right, and I guess most of the agitation is coming from whatever contract that was made between Amazon and UPS, and UPS taking over all of their returns for Amazon users.
Yeah. I still wonder how, Amazon makes money, even with their Prime fee, because you can buy things and then return it. The cost of shipping that thing back eats up, if I was to have to pay to ship that back, which they can't, there's no way they would sustain themselves if they charged me. But I just don't see how they make money, considering they spend so much on return shipping.
Well, I mean, I guess the question to go look for would be, what's the percentage of returns given the percentage of people that keep things and those that are, what is their margin on all of it? I know that it depends on what they're selling. I'm sure there's,
Right.
better margins for better products and other things, but yeah, I'm with you as far as, because you look at, like, I'll see things even with like eBay too. Um, or some of the people that sell things on eBay, people will buy like a $2 item and they'll spend $10 in shipping. And I'm like, anywho.
Yeah. What do you got today?
So I've really just got one article, but I think it's something that Patrick and I can, have some back and forth on. And we talked a little bit about it before we jumped on here. The article was on Market Insider, and both Patrick and I have seen some of this on some of the social media sites, more specifically Twitter. But so the headline reads: the S&P could soar more than 20% in the next year after an ultra rare buy signal just flashed. So what they're talking about is called and I'm probably going to pronounce this first name or first word bad, but it's called the Zweig breath thrust indicator. And it's happened quite a few times in the past. And it's, the theory or the equation was developed by a guy named Martin Zweig. more or less quick overview. It's calculated by taking the 10-day moving average of the top advancing stocks, dividing by the number of advancing stocks plus the declining number of stocks, and it gives you a couple of different percentages. The point is that when a market moves, down 40% in a given time frame, and then moves subsequently up 60% over a 10-day period, it triggers this indicator. And it's, basically what it's saying too is that the market could be now in a bull market versus, what our kind of view has been since the start of this show is, bear market for sure. Recession on the horizon if you're not already in one. But it was interesting because this, every time or most of the times in the past when this thing has triggered, subsequently markets have gone up on average around 20 to 25%, somewhere in there, given the, 18 to 12 months beyond that. So, I mean, I don't know because, I'm sure there's room for this, but my counter argument to it all would be, hopefully, Patrick and I can put this up there, or at least maybe we'll put it in the description as a link to this graph that I have, and it basically asks, of all, between Wall Street, Main Street, CEOs, institutions, how many people believe that, we're going to be going into a recession? And by far, the number one people that believe that we're going into recession are CEOs. I mean, it even outnumbers Main Street, us, all the rest of us. So it's hard because, I think this market's definitely overextended. I think there's a lot to unpack here, and that, one indicator, here's one of the things, to go along with the name of our show is like, you know, these things are a tagline, right? They try and suck you in. There's always I see these articles and it's always like, oh, the stochastic indicator, oh, the relative strength hits some person's call from 50 years ago, and they were right every time since. And I don't ever believe those things. I feel like it's obviously by the headline, it's trying to draw you in. I don't know, Patrick. I know you've seen some stuff about it. What are your thoughts on it, or just
Well,
those kinds of things? And
yeah, 2 points, I guess, off the bat, and it's like you said, the name of our show, and it's why we started. I mean, you and I see it all the time, whether it be in client statements from different clients and other advisors that we're looking at to reevaluate their portfolios, or headlines that we're seeing, or stats that we're seeing. All that can be manipulated. You can create anything and make it to your advantage by using a time period, using certain statistical, venues and all that type of stuff. So it's to say that it's happened multiple times in history. I can believe that because you're skewing potentially the numbers. The other point that I wanted to kind of take off of that is 20%, over the next 12 to 18 months. Okay, is that 20% from the time period that hits? Or is that any time between the next 12 to 18 months, the markets are going to rally 20%? Because I could totally see that happening. If we go down 50%, in the next 3 months, and then we
right.
rally another 20% after that, like, sure, it worked, it triggered, but we're still down 30%. Like, that doesn't make any friggin' sense.
That's a very good point.
Now, I
So
don't know if
also,
that's what this one does, but I can't imagine that, like you said, from here, like rallying, we're already up what? From the low, we're up 8% or something like that from the low. So for us to go another 20% from here, no, I don't see that happening at all in any realm or reality, even if we weren't going into a recession.
so yeah, to your points, Patrick, those are really good. And, it's interesting too, because I also saw an article, or not even an article, but somebody had mentioned a small little thing called, and I'm curious if you've heard of these, it was a synthetic, uh, 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 STR, synthetic transfer credit, something like that. It's like, sounds like a credit default swap is kind of where I think it's going. Anyways, basically the banks they're going out and finding fund managers to take on some of their risk because they can't handle, if they start to have their big loans defaulting. they could be in real trouble, like we saw, back in the Great Recession. Um, but this indicator is interesting. Like Patrick said, we'll have to watch and see. Both Patrick and I are in the same department as far as where our thoughts are. It's hard for me to believe, and that the market's going to go up, any significant amount between now and call it 2025. I mean, we're either going to trade in a range, or, to Patrick and I's point, I think we're going to go down, and hopefully we're going to get a real good correction and a real good bear market, so we can flush out all of this noise
And
and bullshit that's been going on. One last thing I will point out on this article at the very end, it says, all you need to know since World War II, the S&P is higher a year later every time. Part of this article, I don't know what that means, but I guess based on whatever this guy's indicators are, it sounds like every time after there's a war, the S&P's gone up. I'll have to do a little bit more research in that. It was kind of an interesting ending sentence there.
And I could potentially see that, because we're what, 4,600 was the top of the S&P 500. We're at 44 now. If we go down and we have a recession, and that only lasts, let's say, 8 months, and then we rally back up to all-time highs, I think it's going to be rough, but I could potentially see that happening if it's a year, span, because the recession or the downtime in the market doesn't last really long. The only other point that I want to say, because I haven't really dug into this and looked at the history and all that, I've just kind of read the headlines myself, is somebody stated that, all the other times that this has happened, we haven't been on the precipice of a recession. They've either happened in it or after it, from what they,
Right.
they stated, or type of stuff. So not everything works 100% of the time. So this could be one of those times where it's not the case.
Yeah, and to your point, in the article, they do talk about it was one of the times it was triggered was 2009. Exactly to your point. Well, we were done.
Yeah.
We were already on our way up. We were on our way out.
Exactly.
Like, the bad news was over for the most part. It was just like, all right, the dust is settling at this point.
Yeah. Yeah.
But yeah, so good article. I'll put it up there. I'll make sure, hopefully you guys will be able to see this uh, uh, little image or graph thing that I have that will show you, asking a question about, what the overall feelings of a recession are, who it is, if it's Main Street, Wall Street, CEOs of the institutions, and it's pretty good. It gives you a good insight, and that just came out in August of this year, so I found it actually on a good article I read, so I'll put it on there. Hopefully you guys will be able to see it.
All right. I think that's good. I think we've kind of hit a high point. That's a lot for people to kind of take in. So thank you everybody for tuning in to The Half Truth, and we'll see you all again next week.